Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds. Our data helps forecast which parts of the market are about to get hot and which equities are likely to blow up in your face. You can subscribe and get cheat sheets delivered to your inbox. Best of all, it's free. Go to stockcheatsheets.substack.com to learn more.
Now, here's today's free update.
And it's not my opinion. It's not AA's opinion. It is an oscillator that we pay attention to. It's the months to a year to two time frame, the market forecast oscillator called market sentiment. It rolled over and crashed just below the threshold that said we could be in the soup, not necessarily a bear market, mind you, but the soup for the next several months. We'll see if that pans out. It is an election year. I'm Mike O'Connor. I am the author of StockCheatSheets.substack.com, and I'm joined today by Aaron Montel, who is the CEO and founder of Local Advantage Mortgage, and he also blogs on Substack, Macro to Mortgage, is I believe the name of your blog, and you specialize in gaming the bond market. You put your CMT and training hat on. You passed the first of three rigorous tests to be what we already know you to be in reality. I can say it. You're just not allowed. AA might as well be a chartered market technician, but he has to pay the bribe and pass the test in order to be valid. So while he does that, we'll still allow him to forecast mortgage rates. So with that introduction, AA, let's go into the bond market. Before we get going, it was a topsy-turvy week for stocks, but a lot of people argue that stock traders are the dumb guys in the room compared to bond traders.
I mean, some say that the dumb money argument, dumb money, smart money. I mean, money's money.
Bottom line, bonds are important because bond trading anticipates interest rate changes and macro relationships between different asset classes.
Yeah, and obviously interest rates have a meaningful impact on everything in the economy.
Everything.
Yeah.
So it's pretty clear that the economic indicators that would speak to the fastidiousness of current growth leave a lot to be desired, and we could be facing not just a growth slowdown, but a potential serious economic slowdown. And the Fed has had to move the goalposts a few times, or maybe a better way to put it is market participants have had to move the goalpost for the Fed.
Yeah, that's probably a more accurate way for sure. Yeah.
So where do you think, sum it up for us? Again, it's not about your crystal ball. It's about the data and interpreting it correctly. But what are you seeing?
I mean, to me, in the data, the way I interpret it, the economy remains strong. It remains resilient.
You sound like you work for the White House.
I know. I mean, but it's true. I mean, if you look at the data, unemployment is still below 4%. Inflation is still a problem, but a little less of one. And maybe it's becoming more of one as we speak. But GDP is still strong. And, the first read on GDP for the last quarter comes later this week. So that'll be interesting to see where that arrives. But I think if it's rate cuts that you need or you want for whatever reason, you might be waiting longer than you thought you were going to be waiting a week or so ago.
It seems that the theme of not enough workers for all the jobs that are available, that's not going to change anytime soon because we've got boomers retiring and not enough people to replace them and not at the skill level that we would need. And so you're going to have that constant shortage of workers driving wage inflation while the globe falls apart, right? And even though Iran and Israel didn't do a full-on 10-round heavyweight knockout blows against each other, they've telegraphed it. The market took it seriously, and the market said, okay, this global growth story might need to slow down because I don't think the Fed's coming to bail us out anytime soon. Would that be fair?
I think that'd be fair. I'd also add that, that is absolutely fair. But what I would add is that when those conflicts took place overnight, our time, the candles that formed in futures trading were really something, especially this last one, whatever night that was, Thursday night into Friday, or maybe it was Wednesday into Thursday.
Should I go to your chart?
If you'd like, I can bring that up and show you. It's just, let me show you the futures chart here. Let me get back to the right screen for me. And I need to go to a daily. I'm sorry.
No, that's all right.
But look at.
I see you got a big wedge up there. Maybe explain. And that panned out. That turned out to be the right technical pattern.
Yeah, I mean, this was from last fall, the bottom last fall, till just earlier this month, where we hit the high in the S&Ps.
So you and I have been trading together for about 15, 20 years, and we haven't seen too many 7-month stock market rallies in one direction.
Man, yeah, it's rare. It is very rare. I certainly haven't seen one before, not to this magnitude, and certainly not in this environment. With all that we hear about, and yet this is the result.
And so this rising wedge pattern is important. Let's explain it first. I'll explain the setup. You explain how it plays out. But basically, the market has been uptrending, and there are several common points along that underlying diagonal upward slanting trend line that have played out. We keep bouncing off of it and going higher. But what perhaps not as many are paying attention to is the fact that the peaks on the other side, that other line, is showing peaks that are progressively shallower, right?
Right.
And so like a tube of toothpaste, where you're trying to squeeze out that last drop, the volume in the tube itself gets a little narrower, and eventually the toothpaste has to squirt out one direction or the other. And it would appear that the loss of momentum, which we've been seeing for months, the money flow, which used to be in the 0.2, 0.3, 0.4 range for most stocks in the S&P 500, slowly seeped down to a 0.1, and then a 0.05, and then a 0, and now we're even negative on a lot of this stuff. So I know that's kind of the setup, but what technically does a rising wedge represent, and then how does it play out?
So the way it plays out, I think what you just described is basically how it plays, is what it represents. It represents rising prices, but within a very tight and ever tightening channel, which eventually becomes a wedge, and these two lines at some point would meet. And in theory technical analysis suggests that at some point before these two lines meet, price is going to deviate from the channel, and in the case of a rising wedge, probability suggests that it'll move to the downside from that wedge.
And the steeper the rise, generally speaking, the steeper the correction.
That's right.
Right.
That's right.
So we could have a 2/3 retracement and still be bullish in the intermediate to longer term time frame. Correct.
That's right. Yeah.
Yep.
Yeah.
So that means that, and you don't have to do this now, but you probably use a tool like the Fibonacci retracement tool to project where a potential bottom is. I'm just curious where again, there's no such thing as a crystal ball when it comes to technical analysis, but what it does is it gives you places to take shots, correct?
Absolutely.
Risk management.
Right. Right.
So using your risk management hat, what would you think is more likely to happen from here?
Well, that to me, I may have a little different opinion, but I think from here, within the next couple of days, we might see some sort of a bounce,
little dead cat,
something, right? Like what it turns into, I don't know, but I think to expect a continued straight line to the downside is probably going to end up being the wrong expectation.
Sure. So either a sideways, similar highs, similar lows until earnings and the Fed unknowns play out later this year, or we could actually have a little bit of a harmless downside retracement, or the inflation data could get really bad really fast and we could crash. I mean, there's
right. Or we could, and I'm not saying this is my base case, or we could retrace to the point that we retest the underside of this trend line, which in the process would create a new all-time high.
Yep. So another leg up, so to speak. And generally speaking, we don't transition from excessively bullish to excessively bearish unless there's a surprise, right? Some kind of exogenous surprise that takes everyone, it's like basically
COVID.
Something you didn't expect.
Like COVID.
Exactly right. Then you get the straight crash down. But generally speaking, we'll get a transitional phase of some kind. And I think our indicators are suggesting a sideways to maybe downward move is more likely than not for a short period of time. And what I mean by that isn't that we won't go up. Of course we will. As you said, we could bounce back up to the previous all-time high there, maybe even exceed it, or have a series of shorter pullbacks and shorter peaks leading to kind of a triangle-y kind of pattern.
Right.
All possible.
All possible. Yeah.
All right, so that's the stock story, and then just to put a fine tooth comb on this, wrap the stock story into bonds and what you as a mortgage trader an expert at anticipating kind of where rates are headed. And again, the technical evidence just gives you the place to make high probability bets. It's not like you have a crystal ball.
Yeah. To me, it seems that rates want to bounce at least a little bit, and just to be clear, I'm not saying that there's going to be some trend change and, we're going back to lower rates, but this was quite a move in a short period of time. And there needs to be some retracement, just like we said about, the S&P or the indexes in general. What's that going to be? My personal target is somewhere up here around 109. We're looking at a 10-year bond future, so it's a little different than yield. I tend to look at these a little more than yield because of the volume in them. So I just take the action with a little more credibility because there's so many participants in here.
And the practical application here for those joining us from the mortgage shopping side of things is that you're anticipating a run up in underlying bond prices, meaning there should be a corresponding short-term dip in the cost of the 10-year note, and as a result, a slight dip potentially in interest rates.
Right. That's exactly right. And I'll point out here, since we mentioned the wedge before, you see I have I've shown you how this formed a bit of a falling wedge, right? And then it broke out to the upside. And
maybe you could blow that up a little bit so we can see it.
It's still in the process of trying to break out. So you see there was a wedge, and it was a little more pronounced on a shorter term chart, but you get the idea. And then this was that night, Thursday into Friday, where overnight was geopolitical action, which pushed money into bonds, but then it reversed throughout the day as it became clear that it wasn't, a World War III beginning. And
bonds are a bit of a flight to safety in trading terms.
Yeah.
So we have to navigate a couple of slippery slopes here. Tell me if you should be able to see my screen now, and I'm going to take you to the last few days of basically this weekend's stockcheatsheets.com charts, which, by the way, you can go to stockcheatsheets.substack.com, sign up for an email where you'll get neat charts like this, plenty of explanation, and lots of data to help you form your own hypothesis. We don't try to cram down our viewpoint on you because, listen, we've all got one, and it's about as useful as the other things that we have on our body. So let's give you the data so you can make intelligent decisions. But this is probably this would be our core or central trend tracker. We're using ETFs here as a proxy for major indexes across multiple asset classes. And these are not in any kind of order other than alphabetical. But what you're looking at here are what we call the tailwind score. Tailwind score is a composite rating that's comprised of 10 different factors that go into each ETF. The factors themselves are not proprietary. They're the kind of indicators that we all as traders would use in our everyday practice of trying to buy low and sell high, or the opposite. And so the tailwind score, 10 factors, the higher the tailwind score, the more bullish we are about the continuation of a trend. We generally like to see tailwind scores of at least 50. And when we're between 50 and 60, we're just slightly better than even money on the likelihood of a stock continuing to progress. So if we're going to be that low, we need other factors to come along for the ride. One of those is Chaikin money flow. We'll get into this closer. But for now, this is the big picture roll-up of each ETF's 10 factors, then expressed over time. So you can see how things are trending. So, for example, AA, I think it'd be fair to say that in the global diversified bond market, bond prices in general, despite short-term wiggles here and there, bond prices and the bearishness of the ETFs that aggregate bonds are doing worse and worse, right? They're going to zero.
Yep.
And that means that bonds are not necessarily the place that investors are going to run and hide in for an extended period of time. Keep that in mind. We're also seeing that with stocks, though. DIA, which is the parent ETF for the Dow 30, Dow Jones Composite Index. I'm going to skip DOG for a minute. That's a short ETF. But then we have Europe, Far East, and Australia. We have Australia, all kind of moving from either green and or yellow to definitively red. And in fact, as I scroll up and down here, these macro ETFs, there's very little that's red by April 19th. Silver and gold's about it.
Yeah, that's all that's not red. Mm-hmm.
Now, oil may have just had oil and energy have been getting stronger. I'll point you to USO down here. This is the actual underlying futures contracts represented by this ETF USO. It's been green. It's actually been mostly strengthening over the past 3 to 6 months. Had a little hiccup, only down to 44% tailwind score. That's still what we call neutral minus. That's just slightly bearish, but not disastrously so. And that could be nothing more than a consolidation before we rip higher. What do you think? Oil price adjusting downward to reflect the sigh of relief that investors felt when Iran and Israel decided not to whip out the knives. They kept the boxing gloves on and obeyed the rules.
Yeah, I mean, that could be it. I mean, the volatility coming out of that situation just a little bit.
XLE, which is the companies that profit from increasingly higher early prices, oil prices, or other assets, natural gas, for example, that has been persistently strong. It did take it on the chin along with all other stocks. So it's really only gold and silver. And I know you've been nibbling at silver this week.
Yeah, personally, I liked how silver looked. So yeah, I did do a little bit in silver this week.
When it comes to the key indicators that we care most about in terms of whether or not we think the stock market will snap back quickly and resume its bullishness versus continuing to roll over, all of our indications are that stocks aren't going to make a quick 2 to 5 day pullback. Well, we're past 2 to 5 days now anyway, but this is not a buy the dip in that classic sense of you wait for the stock market to give up 5 days worth of profits and then you jump in at a lower high, ready to rip higher again. And the indicators that would be a subset of the 10-factor stockcheatsheets.com pre-trade checklist would be the following. The first is our how we define an intermediate trend. That's the 10-day exponential moving average, expressed here in green, over the 40-day exponential moving average, expressed here in red. And you can see those two moving averages have crossed over. The shorter time frame moving average crossing below the red, the longer term time horizon. That's called a bearish cross. And now officially the 10 is below the 40 EMA. And we have a little stop loss here, which I like to consider my line in the sand, just to give these prices a little bit of wiggle room. But once we breach this dotted line, which is, I believe, 1.5 ATR or average true range below the 40-day moving average, then we have our confirmation that price is broken down and this uptrend, which lasted months, is officially over. Now, AA, you probably use a different set of moving averages, but technical analysts have long agreed that when you have some other confirming metrics, a moving average crossover is a nice, simple way to formulate your market hypothesis.
Yeah, use a longer term to establish your opinion of trend, and then shorter terms help you with timing.
Yep, with direction.
Yeah.
So the confirmatory factors that we pay most attention to are money flow. And you can see money flow is while cheat sheets will always provide you a snapshot in time of money flow, we suggest that it's something you also put on your charting software, the set of indicators that you use in addition to the cheat sheets data. And here you're looking at not only has money flow gotten really negative, it's now below minus 0.2, which is our threshold from going from bearish stock liquidations to very aggressive, what we call distribution. If you think of institutions, they'll accumulate stock. Nobody buys, AA, isn't this fair to say? Big institutional traders, they don't buy their position in one trade.
Oh, for sure. Yeah, that's correct.
Yeah. And in fact, they'll dollar cost average into over a short period of time, not only one instrument, but they don't necessarily look at individual companies. They generally are buying sectors and subsectors or themes that are in favor, and they'll buy more than one. Wouldn't that be fair?
That's my understanding.
Yeah. So when you see money flow dramatically dip from very bullish above zero point 0.2 to very bearish below 0.2 over really the last 2 months and change, very bearish confirmation of this moving average cross to the downside. Now, this would be a lagging indicator. Money flow is calculated based on the most recent 21 days of trading. And while it's a good indicator of whether a stock closed at its low or near its high of the day, and whether or not that lower high was assisted by lots of volume or very little volume. This is, in fact, money flow is a price volume indicator. The numbers would suggest that liquidations at high volume are happening right now, which means institutions are dumping SPY. Now, the two other indicators, what we've shown you so far, are what we call lagging indicators. These next two, the green and the yellow line, for our time horizon, those are leading indicators. And the green line is the intermediate time frame. And this we'll call this is factor 7 on cheat sheets, 10-factor pre-trade checklist. And what we're seeing is the green line falling below 20, which would be very bearish. It's as bearish as we get. So I guess that is the downside. The good news, I guess, is you can't get much more bearish, as they might say in Spinal Tap AA. How much bearish can you get? The answer is none more bearish. So I know you would look for potential reversal when we get when the oscillator dips this extreme, right? You're looking for places, not necessarily one with weak money flow like this security, but you'd be looking for that kind of market forecast orientation with other signs that would indicate the stock is more likely to snap back.
Yeah. You know what, Mike, I also want to point out, and I'm curious what your thoughts here are, because this is the SPX, right? Or the SPY?
Yeah, the SPY, yep.
Okay.
We use ETFs here on cheat sheets because we can universally compare indexes to sectors, subsectors, and stocks.
Makes sense. My thought, and I'm curious what yours are, is that with the weighting in the underlying indice, or the underlying index, and some of those Mag 7 stocks are suddenly coming back down to earth. And NVIDIA had a horrible day on Friday.
Yeah, and by Mag 7, you mean Magnificent 7,
right?
Basically the big leaders that were responsible for most of the market gains, especially early in the rally.
Those high flyers that everybody has been chasing since the fall, they're starting to finally give a little back. But because of the weighting in the underlying index, I think I read today that more than half of the S&P 500 stocks were positive on Friday, but because
that was actually up.
Yeah, and because of the weighting of these few stocks, it's dragging the index down. So basically, it's when are these few stocks that are weighted so heavily? If they catch a bid, will it? It would reverse. But I'm curious what your thoughts are on if they might.
Yeah, later in today's session, we're going to show you the equal weight version of the SPY. So whereas SPY is market cap weighted, so those Mag 7 stocks that AA talks about, they're contributing outsized proportional weight to that index. In fact, tell me if you disagree with this, but I think those top 7 stocks are worth at least a fifth, if not a quarter, of the entire index.
That sounds right to me.
Market capitalization.
Yeah, that sounds right to me. I was reading about that a few weeks ago, and that does sound right. Yeah.
So that means that those 7 stocks can really influence the overall index. And they were, I think I became a broken record in my blog updates throughout most of this late fall and winter, is that this is a very narrow rally. Well, now we can, I think, argue that this, in terms of the really intense selling, this is mostly high-flying tech stocks giving back, doing mean reversion retracements.
Yeah.
The market sentiment line is a longer-term index. Now, typically, when we see a market sentiment that reads bullish or very bullish, and when we're above 80, the line itself, this is the yellow line or the orange line, the mustard colored line below the green line, which was the intermediate time frame. This longer time frame sentiment line can move in any direction as long as it's over 80. And what it's telling you is that this is about as bullish as momentum gets, but beware, because the answer is that the next move has to be lower because there's no move higher left. So we always like to try to be involved in rallies at that point where we're transitioning from neutral positive into bullish or early phase bullishness. Here we're seeing the opposite. We're at the very beginning stages of bearishness. And on Friday's close, something very important happened. The long-term market forecast oscillator closed just below 80. Now, it's possible this is a whipsaw, and by the time you're watching this video, the futures are already erasing most of the losses from last week. But Double, I think that it's worth spending a little bit of time on the market sentiment indicator and what it means when we start rolling below 80, and probably more importantly, if the momentum continues to the downside long term, it's that cross from above 50 to below 50 that's so significant.
Yeah, I agree with that. And as a side note, since we were just talking about NVIDIA for one of those Magnificent Seven stocks, it's just found its way below its 50-day moving average for the first time since October. So it's an important line in the sand.
Yep. And so the 50-day moving average is something that we would forecast as likely to happen when we start to see things like the market forecast or sentiment lines crossing below their thresholds first. So this is why we consider these early warning indicators. And this is telling you that the intermediate trend is very bearish and under threat for continued bearishness. At the same time, the long-term trend moves from very bullish to now mildly bearish. So the fact is that any attempted rally now will face this increased bearish pressure because it's on a superior time frame. So whenever we have a bearish forecast oscillator in the time frame above the forecast and or actual moving average of the time frame that we care about, in this case intermediate time frame, whenever that senior time frame is going against you, it generally means that any rally you get, and it's possible to get a nice rally, it's going to be short-lived and will fade quickly.
Yep.
And now we can do the major indexes, and we'll speed this up a little bit, but these tailwind scores are about as ugly as we see. And again, we're still talking about 4 indexes, AA, that are in long-term uptrends, which we define here as the 10-week moving average greater than the 40-week moving average.
Okay.
So any Wall Street pundit will tell you, what are you talking about? Very bearish. These stocks are in long-term uptrends, these indexes, these index ETFs. And yes, they would be right. But again, we're using leading indicators as part of our tool set to anticipate where the market will go next. If you're Wayne Gretzky or Connor, what's his name? Who's the, you're not a big hockey fan, are you? But you know what I'm talking about. Connor McDavid, I think his name is.
Okay.
You know, the hockey player, he doesn't skate to where the puck is.
Where it's going.
Right?
Yeah.
So yes, we're in a long-term uptrend. But what's happening here is the intermediate forecast now, and I am at factor 8, is very bearish. And factor 7, its senior time frame, leading indicator, is now moved from very bullish to slightly bearish. We call slightly bearish neutral minus. So those timing indicators, the leading indicators, are telling you this long-term trend is not going to last. And the other factor that we look at a lot is buying pressure. Now, buying pressure, Double, is the same. We use the term buying pressure and money flow or shaken money flow interchangeably.
Right.
And when we're very bearish, we're below negative 0.2. When we're bearish, we're below negative 0.1, but we're not quite below negative 0.2. So that gives you an idea of how we translate money flow into these ratings. So factors 4, 8, and 7 in bear markets are incredibly important, much more important than factors 1, 2, and 3, where we anticipate trend rather than look at trend and say, I'm going to trade what I see, not what I expect. That could be dangerous in bear markets.
Yes.
So let's add some global stocks. Anything here surprise you? I don't know what's been going on in Italy. I know that's a country you're very interested in, but obviously they're very bearish in the intermediate term, like the rest of the G7. But what's been driving Italy's economy, if you know, and you may not?
I don't know. I'll tell you that I did read a story about Italy this morning where there's some problems with their state-funded pension program. Yeah, and I'm no expert on it, but that was a story that I read today. Yeah.
Yep. Talk about a country with colorful politics. It kind of makes the U.S. feel bland and boring by comparison, and that's saying a lot.
Yeah. Yeah.
So we've got UK and Italy, which really didn't participate in the 7-month rally very much. In Germany, these are least worst choices compared to the SPY, which is pulling up the rear. I guess it's interesting to know that the economic circumstances in our sister G7 nations is a little bit more dire, and the need for rate cuts is more obvious there than it is here. And so, what do you make of? I don't have the data here to share, but the yen in particular. But there's a number of currencies against the dollar that look just terrible, like as in financial crisis terrible.
Yeah, no, it's becoming, it's been going on for weeks, if not months. It has been going on for months, and it's becoming, you're hearing more about it. But yeah, the yen in particular is at decade low. And this weekend, there's an IMF meeting, and I'm sure it's a topic of discussion. So we'll see what comes out of that.
Mm-hmm.
But the dollar's buying power, buying pressure is becoming a problem for everyone else.
Yep. And obviously the fact that the United States has this dual issue of potentially growth and inflation, that's what's causing the Fed to imply that it's going to be a while before they lower rates.
Yeah.
And that strengthens the dollar. And when you have other countries desperately in need of money printing in order to pull their markets out of the economic malaise that's going on, you start to get some really big distortions. I guess it's good for me. I'm going to Europe in June, and I'm looking forward to. I'm not trading in my euros quite yet.
Yeah.
Or my dollars for euros.
I'm going later in the summer, and I'm thinking about maybe exchanging for some euros now.
Oh, you're thinking about doing it now? You think maybe this is the time? Don't wait any longer. Don't get greedy.
Maybe.
Yep, possibly. So what we're going to do is look at the macro chart. Again, this is the cheat sheet's 10-factor model. Keep in mind that the factors 1, 2, and 3 on the left, they all contribute what they contribute to the overall tailwind score. But when you see something that's close to being possibly bullish, like, for example, SH, which we'll talk about more when we get to pure short trades, or oil that had a pullback, but maybe winding up for another run, or gold and silver, which I think had been doing very well, almost like too well, explosively well. I know that the previous Friday, we ended up with a bearish engulfing pattern, and I think there was some sloppiness early week, but I think gold and silver got better as the week went on. But maybe you could, do you have a chart you could pull up for us and maybe take a look at those two?
Yeah, I sure do.
I know you were trading them, so let me get over there to the AA platform and explain what underlying you're showing to us. So look at that parabolic move, and is that gold?
That is gold. That's GLD, which is an ETF that tracks the price of the commodity.
Well, that's certainly signaling something. That is not a normal gold chart. For 4 years, we've gone sideways.
Yeah. But there's this, it broke out here. When was that?
Yeah.
Late February. And
it sort of tried to retest.
It sort of kind of. And it's been a parabolic move. But also, I haven't drawn on this chart, but there could be a case that this is another one of those, maybe a wedgie looking thing. But certainly trying to flatten out right here. That's for sure. Could be
a bull flag first, because don't these explosive moves tend to happen in threes, right? We get the initial move, then a flag,
which we did.
Yep, and then another big move, a bigger flagpole, and now the beginning of a flag.
Another flag. So there could be another leg higher. Absolutely.
Yep, and generally that third leg is not quite as it's usually the weakest of the three. Right.
The second is usually the strongest. Yes.
Second is the strongest. That's right. And so then we typically would have some kind of correction after that. But so this might be a good time to do call spreads or covered calls or in the money diagonals that last a couple of months, just something to allow you to take advantage of sideways to up moves while being in the underlying without face and paying for your time decay by selling an option.
And while gold, while the move may not be over in these precious metals, silver, looking at here, hasn't had as powerful of a move, even though it's had the same thing, had two moves, and now it seems to be flagging. Silver may have a little catching up to do with gold. So that's why I personally chose silver over gold.
And going back to the data that I was sharing, I'm gonna take the stage back here, and I think this is me. Now we can take a look at gold in terms of other asset classes. The problem is the other asset classes we care about is SPY. It's way down here. So SPY, and it looks like I've got this could be actually because SPY's score was 8. So I may have an erroneous, this could be erroneous because the tailwind score isn't supposed to change. And I noticed that it's lower than it should be. So I'm going to stick to this. We know that SPY is doing poorly. Gold, though, what we like about this is this would be the set of indicators that would suggest another flagpole is coming. Buying pressure no longer very bullish, but still bullish. So that is, keep that in mind, that we're starting to lose. We're still very strong, but in terms of relative momentum, down a tick. 74 is an optimal tailwind score. The fact is that we have neutral plus, meaning slightly bullish outperformance against what's called the Russell 3000 or the ETF IWV, which is what we use here. So in terms of the broader market, which has been outperforming everything for 7 months, gold suddenly is now in both the 3 and 6 month time frame outperforming the IWV, and that's all thanks to shorter term time horizon gains that have happened in the last few weeks. An explosive move. And
go ahead.
And then very bullish long-term and intermediate term market forecast. That's as strong as stocks get or ETFs get, but it also tells you that there's no more room to go higher. So we're closer potentially. And when I say the end, I don't mean the end of the long-term trend. I mean simply the end of this first spurt. We could have 9 months worth of 3-month spurts. And we're just at the end of this first 3 months. You were going to say something, Double A?
I was going to ask you what you make of the fact that gold and dollar are rising together, which historically is not how that relationship works.
Right, because normally gold is it's an alternative currency, and generally speaking, when the dollars goes down, gold goes up.
Yeah,
because when dollar loses its buying power, gold looks more attractive on a relative basis. And then the second thing is gold doesn't do well when the Fed is tightening. So the fact that we have gold exploding while the dollar is exploding, mind you, every other major currency, and we can actually show you that here. FXI is, I'm sorry, that's the stock market for China. I think I have some currencies in here. No, I guess I don't. I've got a number of different stacks. This one doesn't have currencies in it. But I think it would be fair to say the yen, the euro, the Swiss franc, all lower against the dollar, and not just a little, but a lot lately.
Much lower, yes.
Yeah, to the point where, and so this is saying a lot because gold acts as an alternative currency, as an inflation hedge, and as an Armageddon trade, right? When things are going to get really, really bad. I remember I traded a ton of gold during the 2007, 2008 financial crisis. And gold just perpetually went up against the backdrop of those Lehman and Bear Stearns crashes. Gold was a solid estimate to have. So one of the things is that the IMF warned the United States again for its excessive spending. So I think gold as a stand-in for the dollar's buying power is still something at work here, even though, yes, the dollar's going up. I think that gold in dollar terms is expressing its value relative to other fiat currencies that don't have the Fed backstopping it like the dollar's got. And those currencies are in free fall, and gold is trading in inverse proportion to those other currencies. And then finally, I think there is some concern when you've got major powers like Iran and Israel actually striking each other directly up and, until we realized that there was a very, very conservative, if not
theatrical was the word I like.
Theatrical is a great word.
Yeah.
Yep. I think it's fair to say that the anticipation of really bad times ahead is not off the table, at least in terms of how gold's acting. What's your opinion now that I've given you that soliloquy?
Yeah, I agree with everything you said. If you flip over to my chart real quick, I want to show you something that, if it's possible, I just want to show you something.
Yep, absolutely. Keep sending us back to the charts.
That I find interesting, and it's this. If you look, this is over 20 years of history.
And you're on the monthly candles.
I'm on monthly candles, and this is the U.S. dollar versus the Japanese yen. This is the highest point in the last 23 plus years that the dollar yen exchange rate has been. So
Good time to visit Japan.
Yeah. So it's certainly saying something, and I don't disagree with anything you said as far as is what gold is trying to tell us. It's oftentimes I think mainstream narratives focus on one thing, and it's never one thing. It's often many things. And those that you pointed out, I think I agree with.
All right, so let me get back to my charts here. And I'm going to skip over this global macro just because I'm afraid that, there's SPY at 8%. I think I had a wayward chart in before, okay. But we're at the very bottom of the curve here, where VTI represents the total stock market. That's everything in the United States. I'm sorry, it's the total U.S. market, and then SPY as the large cap subsidiary is right underneath it, and then IWM, the small cap subsidiary, all red as red can be. Only the long-term trend is intact. So one theory is all of this noise could happen, but eventually the inflation story will get under control. The Fed will start loosening, and then this long-term trend can resume. I think it's a lot of wishful thinking, but it is possible based on how the long-term, the significance of the long-term trend. It's just that we lost the forecast that supports that notion, and that's a big deal. And I don't know if you see anything else interesting. I thought financials, it's the fact that they're puking those up too, very bearish. That's a negative. We do have some kind of bullish near-term momentum going on right now. So anyway, it's a sit on your hands versus the stock market. And here's treasuries, natural gas, the one energy stock not participating, and AGG we've talked about. Now we can drill down into sectors and get a little bit more dialed in about what's going on. So now we discount the rest of the world and other asset classes, and we focus purely on the 11 subsectors and a few of the market indexes just for comparative purposes. And here, Dubs, I think you and I both in our pre-recording meeting noted that XLU, which is a defensive ETF that has not been doing well at all during this rally. They're starting to rotate into it, and this one is starting to move. The metrics look pretty good. Buying pressure is no longer negative. There's actually institutions lightly accumulating XLU to the point now where we're getting some near-term market forecast bullishness. And again, it's been enough to pull up the intermediate market forecast, and because the intermediate market forecast has been bullish, it's been enough to pull up eventually the long-term market forecast, now bullish. We know it's early because we're still underperforming the IWV, the Russell 3000 on a 3 and 6 month basis because factors 5 and 6 are still red. It's showing me that we're rotating into XLU and not just with our tippy toes. We're putting our big boy boots on.
Yeah, and I mentioned to you earlier, I find that interesting because what I find interesting is the fact that XLU and yields are both rising, because XLU is typically a yield replacement, right? And if you're looking for yield right now, you could go into anywhere on the curve and get more than 4%, but utilities are paying less than 4%. So
it's more about the capital appreciation of XLU versus the yield you can get. And one other thing to note is that a consumer has to pay their electric bill or their gas bill, but they don't have to go out and buy Clorox bleach, right? Although we think that during tougher times, inflationary periods, consumers will whittle off the discretionary items and keep the mandatories, the food, the medicine cabinet, the laundry room.
So then why is XLP not even close?
That's what I was going to point out. Why I think this XLU move is a flight to safety, and why XLP isn't, because we've got inflation impact. Well, inflation's impacting both, but XLP, you do have some latitude, right? You don't have to buy Tide Pods. You can buy some cheaper soap. And so I think the consumer running out of credit, which is affecting everything here. Did you see how we've returned to worse than pre-COVID levels in terms of the amount of money consumers have in the bank after years of quote unquote being flush with cash?
I've seen the savings been drawn down. Yeah, for sure.
Savings drawn down and credit card balances up, defaults up. So I think this is a consumer story. Now, of course, XLK, we know what that story is. Corporations cut their CapEx budget and their operating budget when they're facing tough times. And after the kind of run we had with that AI palooza, this doesn't surprise me at all.
No, not at all. There's a lot to give back there.
Yeah. Now, just because the price of oil corrected, I would still argue that energy is definitely down in terms of buying power. Buying pressure. Factor 4, neutral plus, not very bullish anymore. And the long-term market forecast is still good, but the negative sales momentum in the near term and factors 9 and 10, while they're okay today, early in the week when oil gave up a lot of its gains, when the markets all breathed a sigh of relief, it was enough to roll over the intermediate forecast, but it didn't take out the longer-term market forecast. So I'm looking for energy to rebound in the next week. Unless the economic data supports the narrative that we both suggested as far as XLP goes. That is, if the consumer is not healthy and market conditions are generally deteriorating, we're not going to see energy pick back up.
I think also this week, we're getting, like I mentioned earlier, first print of GDP. I think that could move energy as well, right?
Yep, and everyone's expecting a pretty hot GDP.
Right.
And then down below, I just wanted to point this out, XLY, consumer discretionary. Again, other than the market long-term trend still being intact, that weeks to months trend, everything else is negative. Real estate, clearly, home builders got a break for a little while, but overall, real estate is pretty terrible. So no stimulative rate reductions coming anytime soon based on what traders are doing with the XLRE.
Yeah, the rate buy downs are squeezing home builders' margins pretty hard now.
Yep. So I'm going to move over very quick to one other thing that I think we started here. Let me inflate that. We talked about GDX XME, didn't we?
I think so. Yeah.
Yep. And then financials are next, but other than the fact that financials, the two bank stocks, KRE, which is regional banks, KBE, money center banks, 21 and 13th in the average 3 to 6 month relative strength rank, doing better than that in the 50 to 10-day look back period. So we are starting to see a little bit of a reversal of fortune in bank stocks. No money flow going along for the ride there. Curious your thoughts about, do you see any potential for contagion in the smaller banks? The relative strength is not suggesting that there's anything brewing that's going to cause real serious market turmoil. But I'll be honest with you, I haven't been reading up on those segments.
I'll be honest also, Mike, I'm not an expert in the space. So I don't know, but the charts and the data you have here suggest that there's no, large issue in the wind, at least not yet.
I think we both pointed this out. XITK and XSD, innovative tech and semiconductors. Sorry, my data feed must have broken down in terms of the labeling. But and home builders was a high flyer. Now, home builders, it's only been 20 days. The money flow is confirming that rotation, but we have to wait and let that one play out. But the rotation out of tech, that's for real.
Yeah, I will just add the home builders started reporting, and I think that's where we're starting to learn of their margin compression. So that probably has something to do with that.
Got it. Okay. And meanwhile, innovative tech, this is where you'll find NVIDIA and its brothers and sisters in the AI space. And then chip stocks are in the XSD, and both experiencing what I'd argue, at least chips, a FOMO level of get me out.
Yeah.
That's industry groups. And then what I wanted to do just to wrap things today, AA, unless there's something else you wanted to explore, is very quickly that if you subscribe to Cheat Sheets about twice a week, sometimes more when the market data supports it, we offer free subscribers an analysis of the ETFs that we think are either most likely to outperform and weather the storm during turbulent market times, or that will way outperform, meaning they can act like alpha in your portfolio and do a better job even with the expenses relative to a passive index fund like a Vanguard fund or the SPY. And so you get those delivered to your inbox usually midweek and on the weekend. And this morning at stockcheatsheets.substack.com, we made our ETF picks. There's a bunch here. And most of these are safety plays that either coincide with the metals and mining theme, or they're doing things like hedging out Japan's currency, the yen, because we know the yen is in free fall, but Japanese stock market, they've got the printing presses on, and there's nothing to be, you certainly don't want to thumb your nose at a printing press supported stock market. We know that from experience, right, Dubs?
Yeah, that's right.
Yeah. So I'm not going to get into these ETFs, but we also, except one, we'll offer one spotlight pick, and that would be Go Gold. It's part of the precious metals and miners. GOAU is the ticker symbol. And you'll find that it's a very high expense ratio ETF. So you are paying for some active management. I'll just point that out, that the expense ratio is 0.6. And that could be a detriment. But it's offset by, the fund managers have actually engineered things to provide about a 0.79 dividend yield. So offsetting, I guess, after taxes a little bit. But the fund's performance has been outstanding, and we know that gold is in theme right now. So to wrap things up, I wanted to spend just a couple of minutes with you, AA, on something that we use in bear markets, but they tend to trade very differently and need a different strategy and approach, a more accelerated version of Cheat Sheet's 10-factor trade list. And so I'll be curious from your perspective, to the extent you use these leveraged and non-leveraged short or inverse ETFs. We kind of go through what to look for, what to be concerned about in sort of a checklist form in today's update. But then we also rank on a relative basis the top performing double short, triple short, and non-leveraged short ETFs.
Okay.
And we have a few here. So this is a kind of a different measurement. The first place I always go to is the Chaikin Money Flow Score. That is the foundational thing that you want to be working. 0.1 is good. 0.2 or higher is great. Institutions are along for the ride and generally are driving stock prices higher with volume. Next to CMF are the actual trends themselves. The trend on the furthest left is the shortest time frame. That's the 5-day over the 20-day EMA. If it says up, it means the 5 is higher than the 20 and price is moving along accordingly. Down simply means it's bearish. The 5 is under the 20 and price is likely moving lower. And then we have our intermediate trend, which is in the middle. That's the 5 over the 20 exponential moving average. And then basically the equivalent in the weekly chart. Now you can see here, what we're looking at is a bunch of ETFs that are just getting going. How do we know that? We're seeing the relative strength rotation go from really bottom of the barrel, double digits or worse, to and about midway through the sweet spot, which is that 120 to 60-day period you see above. We start to see rotation, 11th to 3rd to 7th to 10th, TECS or TEX, the bearish technology fund. And you can see that starting at the 60-day mark, that particular ETF has been persistently strong versus these other ETFs here. And so that's kind of the next place you want to look. And when you're seeing transitions that are closer to the 60-day mark, and that's where I think a difference is here. What would be a fair way to describe the timing on bear market trades compared to bull market trades? Double, don't you tighten up your time horizon?
Yeah, I think you have to.
And you're more of a put buyer, but the same principle.
Yeah, I'm definitely more of a put buyer, same principle. I'm also more of a future seller,
right?
Than things like this that are leveraged.
So you're not using inverted ETFs, but still, and so yes, for really long-term declines, the cheat sheet system is good. But when it comes to simply profiting off that initial move or the secondary move lower, because a lot of times that's all ETFs are going to give you, especially when the market is in a long-term bullish uptrend. And so you got to tighten everything down. So I find relative strength rotation is more important in that 10 to 60 day period than in the 60 to 120 day period.
Yeah, I agree. My limited experience with these leveraged products is that they're trading vehicles. They're definitely not investment vehicles. You want to get in and you want to get out and move on.
We give you a whole laundry list of different factors that can affect your your success rate when trading a short or double short ETF. You can be completely right about the direction and get your ass kicked in terms of the money you lose in the trade.
Yeah, absolutely.
And that's because of leveraged instruments that have expiration dates on them. And so we're not going to get into the weeds, but we'll give you maybe one example where you've got a ETF that's based on a commodities futures contract. And the ETF, they do a better job now. My understanding is they diversify across different time frames these days. So we're not talking about only the near month futures contract expiring and rolling to the more expensive next month. Is that true these days?
I don't know.
Yeah, I think that's true. Like, for example, USO.
I do. That's true with USO.
Yeah.
Yes. Yeah.
USO used to be strictly a ETF where it would be, and the oil markets. This part of this is because of the way oil markets function. The spot price is meaningful to the price of energy, and the spot price simply means the futures contract that's about to expire, right? So when oil spot price is based on the supply and demand over what's called the near month futures contract. So the next futures contract, I think, expires in the third week in May. Is that right for energy? If you know, neither one of us are commodities traders.
Yeah.
So second or third week in May. And anyway, what used to happen in the past is that as you get closer to that expiration date, the value of that ETF would change because the ETF, the futures contract underlying the ETF, starts to lose its urgency. And that's because the fund manager is doing what's called rolling to the next month. So if we have an expiration in early May, as we get closer to that deadline, the fund manager needs to swap out the futures contract that set the spot price up until that May expiration with a new spot price setting futures contract in June. The problem is that the further away you are in time, the more expensive the futures contract. And that's because you're giving the stock or ETF more, in this case, ETF or underlying futures contract, more time to move.
Right.
And so when we talk about rolling, you are selling what's cheap and buying what's more expensive. And that impacts the value of the fund. So that's one example of how leveraged products can fail you because of what's called the cost of rolling. Is that a fair way of describing it?
And I would add to that, Mike, it's not only that you're buying what's expensive, but the premium you pay for that thing that's more expensive bleeds over time as you approach its expiration date. So unless you also achieve a move in the underlying to compensate for that loss of, the time premium, then it becomes a cycle where it just becomes, you're paying more to roll lower and lower, basically.
Yep. And this is especially true with commodities-based ETFs, which are they're leveraged. They're 2X and 3X is largely leveraged through options. And that's where you get into this time decay notion, where options lose their value a little bit more and more each day, like a melting ice cube.
That's right.
Yep. So with that as the backstop, these are the best of the probably 60 fairly liquid double and triple short and non-leveraged short ETFs out there. You want to pay attention to the 60, 70, 80-day mark to the 10-day mark, rolling into favor, not out. Now, if you're rolling into favor and you're in the top 50% within that that pinkish colored, orange colored sweet spot, that is part of what's required to get a trade grade. That's the grading on the right-hand side. We do B's and A's or you don't get a grade. Well, in order to get any grade, you have to be in the top 50%. In order to get a A grade, you have to be in the top 50% in that sweet spot look back period. And you have to be in the top 30% on average. So your average rank needs to be in the top 30% in the 50 to 10 day look back period, the nearer term look back period. So in other words, to get an A, you've got to show increasing growth, meaning momentum, meaning higher price performance rank relative to everything else in this list. And to get a B, the standard is slightly lower. You don't need to have that top third to get a B. You only need to have that top 50%. But in order to get a B, you also have to have either the long-term or the intermediate moving average bullish, meaning it up, preferably. And in order to get an A, it has to be both. So it takes a while for the long-term moving average pair to cross over bullishly. And most of the move in an ETF that's leveraged like what we're talking about. And in this case, when I say making a bullish move, we of course really mean a bearish move. Remember, these things trade in the opposite direction. Mm-hmm. So it's a bullish bearish play. So to make a long story short, waiting for an A grade almost hurts you because moves happen more quickly in bearish trades. And we don't need the long-term moving average pair to cross over to feel good about the relative strength and momentum of the stock. Would that be a fair assessment?
Yeah, I'd agree with that.
But having the 10-day cross above the 40-day intermediate time frame, great. Well, to get a B, one or the other has to be true. To get an A, both have to be true. So know in the top of your mind, a grade B for the purpose of trading a short ETF is probably preferred over an A. If you do get an A, then you want relative strength to be persistent. You want it to be pretty much in the top 30% from the sweet spot up to the shortest look back period. You want to couple this positive relative strength momentum with a 0.1 money flow score at a minimum, preferably 0.2 and higher. We call that a FOMO level. So as we look at this chart, LABD, the biotech triple bearish ETF, sort of hits those marks. I'd like to see better money flow, but we're moving from low double digits to high single digits that have been persistent for the last 70 days. We also have one of the two trends in the longer term time horizon bullish. We have money flow that's at least above 0.1. And if you read today's Cheat Sheets blog, and this is something that is pre-paywall and shared with all current subscribers, we give you the thesis behind biotech. And biotech has problems that go beyond a few technical machinations. The reason biotech has blown its support level is that we've fallen out of favor because Wall Street analysts know that a key issue is the pressure on all clinical research organizations, and biotech is completely dependent upon research. So biotech companies, clinical research organizations, or CROs, have been struggling with resource constraints and complex demands of integrating new tech. That's another problem, is that the AI and machine learning rollout have to be integrated into operations. That's required sort of a remastering of business processes. So, and then the final thing is there's VC funding has dried up here. Biopharma's supply chain, its ability to get funded for lab work that kind of proves the hypothesis required in order to go to market, that's a huge traffic jam. So it's a long-winded way of saying that the fundamental analysis can still matter a great deal when you're trading things like this. But these numbers manifest that thesis. In other words, if you don't know anything about the sector or industry group you're shorting in the way of a long investment, know that with Cheat Sheets, when we make an ETF pick or a stock pick for premium subscribers, we're doing that fundamental work. We're checking price to sales. We're checking whether insiders are buying, whether analysts are upgrading the stock. So we're doing all of that. We're checking key financial ratios, and we're watching the news for any kind of negative developments over the last quarter or two. So when we put something in the spotlight, know that you've got a fundamental analysis that we may not put an emphasis on that when we're putting these charts together, but know that in the background, you've got fundamental corresponding with then good data. And that combination does raise the prospect for trades that can last to the downside for months and not just days. Still, though, it's rare. You think we've just claimed that enough?
Yeah, I think so.
Yep. So if you'd like to learn more about how AA goes about his magic of anticipating the next move in interest rates, you can catch up with him on his blog, which is called Macro to Mortgage. And when do you publish that? Generally early in the week?
Generally, yeah, usually every other week.
And then is there a paid, or is it just are you just doing it as a free-for-all?
It's a free-for-all. It's a free-for-all.
Free-for-all. You can also visit AA if you're in Colorado and interested in employing his services for mortgages at localadvantagemortgage.com.
That's right.
And I'm Mike O'Connor. I bring you cheat sheets a few times a week, stockcheatsheets.substack.com. Lots of value for free subscribers, even more value, premium stock picks, at least twice a week on Money Flow Mondays, Relative Strength Wednesday, and again, big extensive market recaps like we've given you today. In a few words, AA, give me the market assessment for the next 3 to 6 months. While you're thinking, I'll give you mine.
Okay.
I believe that the markets are not in free fall, but that the party is over. And by party, I mean the 7-month rally. And because we stayed at the punch bowl and drank our asses off and got completely schnookered, we're going to pay for things in the form of a hangover. We're going to be looking at corporate profits in the form of earnings announcements, and particularly forward guidance is going to be really important. We would expect that if we're going to get another leg, another multi-month leg to this bull rally prior to the election, we're going to need to see some leaders coming forward outside of tech, which I think needs to rest here. So look for new leadership in outside of home builders and tech that can carry the weight, perhaps consumer discretionary going into Q3 and Q4, perhaps industrials, as there's a pressing need to reindustrialize or reshore industry to increase U.S. production capacity. You've got Biden's multi-trillion-dollar CHIPS and capital improvements acts coursing their ways through the country right now. You'll notice that infrastructure is a big theme in the stock picks for premium subscribers today, and even in some of the ETFs that we've recommended today. So keep in mind that industrials is likely to be hot, even if the bear market is not. So I am short-term bearish, intermediate term mixed, longer term, meaning before the election, I think we got another killer run in us. And we'll have to see about next year. First year of a new presidential administration is usually rough for the markets. So that's my long-winded prognosis. Did I give you enough time?
I think so. I'll make this really brief. I think that my opinion is in the next 7 months, so sometime before the end of the year, we will both achieve a new S&P high and a new high yield for the cycle. And I don't think the Fed cuts before the election.
I agree with that about Fed. I think the inflation is here to stay for years, not just months.
Yeah.
Mike O'Connor, AA, thanks for watching. We'll see you again next Sunday.
See you, Mike.